Welcome to Managerial Accounting at Antelope Valley College. This is Professor Adams, and I'm going to give you kind of a quick speed lecture through the prologue, which is before Chapter 1 in your Managerial Accounting text. So forgive me if I'm going a little bit fast. I want to hit on some key points, but I still encourage you to read the chapter. So first, as we dive in, we need to understand the difference and the importance of financial accounting and managerial accounting. You might be wondering, why do I have to take two different accounting courses? What's the difference? Why do I have to spend 2 semesters studying accounting when I don't even like accounting? So first, financial accounting is focused on external persons. So outside people who are going to make financial decisions. Remember, we always talked about making sure our financial statements were fair and accurately stated for outside readers, so investors and creditors potentially. In managerial accounting, our users are going to be internal users, managers who plan and control an organization, so for internal decision-making purposes. So that creates a different focus. So when we talk about our time focus, financial accounting is always looking backwards on what happened last month, last quarter, last year. So we do all the work, we record the transactions, and we prepare financials based on what's already happened in the past. So it's always historical. Where managerial accounting, we might use some of that historical data from financial accounting, but our emphasis is going to be forward-looking into the future. So we're going to be using what's already happened and our knowledge of our business and what's going on in the economy to make projections going forward. So a little bit different in terms of that focus, which ties in with this next concept, verifiability versus relevance, as well as precision versus timeliness. So in financial accounting, we want our financial statements and our data to be both verifiable and precise. We need the best accuracy that we can get, and we need our data to be backed up by actual transactions. It needs to be documentable and verifiable. Where in managerial accounting, our emphasis is going to be on relevance and timeliness. So we might make some estimates and we might kind of guess at a few things and project forward so that we have timely budgets, for example, or timely estimates in certain areas of managerial accounting. So we're always forward-looking, which means that sometimes we have to give up a little bit of accuracy so that we can have information timely. In terms of the subject, financial accounting is going to be focused on company-wide reports. Sometimes we can break them down into different units, but in managerial accounting, we definitely want to break things down as small as we can, which is called segment reporting. And sometimes we'll be doing accounting for a whole company or for a particular segment or a particular product, a particular job or client. So we're going to break things down in ways that maybe you never thought we could break them down before. When it comes to rules, financial accounting needs to follow GAAP, remember generally accepted accounting principles, and that IFRS thing. Do you remember reading about that? And we have prescribed formats for our financial statements. There's a certain amount of information that needs to be contained in an income statement, a balance sheet, a statement of cash flows, statement of changes in owner's equity. All of those have certain requirements. When it comes to managerial accounting, there really are no rules. It's what do we need internally as managers to make decisions. And we might find ourselves creating new managerial accounting reports and coming up with new ways of crunching numbers that are useful to our particular organization. In terms of the requirement, financial accounting is required for companies. They're going to need to do it. Even small businesses who may not keep up with their accounting throughout the year, eventually they're going to need their financial accounting and they're going to have to file a tax return. So it's going to end up being mandatory even for the smallest of small businesses. Managerial accounting is absolutely not mandatory in any way, but what I find is that people use managerial accounting that they don't even know that they're doing managerial accounting. Even small business owners. I can think of one small business owner who's a restaurant owner, and he really was not an accounting guy. He was not good at the business end of running his restaurant. He was a great person, great ideas in terms of his restaurant and recipes and managing people, So he had a lot of good skills, but the business and accounting end was not his thing. And so he was shocked to find out that he'd been doing managerial accounting in some form for a long time. I was talking to him one day, and he shared with me that he'd kept this little black book in his pocket for about 20 years where he recorded how many customers came in for each meal at his restaurant every day of the week, lunch and dinner. And he had recorded this, and he was using that data to help predict how many customers he might have in the upcoming week or the upcoming month, so he would know how much food to order and what to prepare for. So that doesn't sound like accounting on the surface, right? We're not talking about dollars, but we're talking about important data that's helping him make plans and essentially budget for what's ahead. So that's definitely managerial accounting. So the work of management is planning, controlling, and decision making. And we're going to see how that plays into managerial accounting. So first we need to establish goals. Then we're going to specify how those goals will be achieved, and then we develop a budget. So let's say our goal is to have sales of $1 million this year. Well, how will those goals be achieved? What we might find out in this process, well, last year we only did $500,000 in sales, so how are we going to double our sales? There's going to be all kinds of things that are going to need to go into that, and we're going to have to find out if we're even capable of doing it. And we'll develop a budget, see if it's possible. And what we might find out, it's possible we could find out in that budgeting process, hey, look, we can't do sales of $1 million this year, even if we wanted to, even if we tried our very hardest, we couldn't, because we just don't have the capacity to handle that much product or to provide customer service or ship all of those units. So it might be that we need to develop a plan that we can acquire the right employees, the right materials, the right resources, that maybe 2 years in the future we can get to $1 million in sales. And that's why we do this. We can't just throw a goal out there and think that it's achievable because we want to. We need to actually develop a plan using numbers that shows how we can get there. And sometimes that involves long-term planning so that we can actually achieve a lofty goal. When it comes to controlling, the control function is where we're going to gather feedback to ensure that those plans are actually being followed. Now that's a critical one. That sounds really basic, but I know a lot of businesses and individuals that have trouble with this part. How many of you have a personal budget? You have some kind of idea of how much money you make, and you've penciled out, maybe in your head, maybe actually on paper, maybe in Excel, if you're starting to get a little more into your budget. You know how much your rent or your mortgage is, you know what your insurance is, how much your car costs you per month, you budget for gas and food and your phone and your internet and a few other things. You're like, oh boy, that starts adding up, right? But you've penciled it out. I remember being a college student and having penciled out how much money I was making at my job and what my monthly costs were. So that was my budget, right? But how many of us actually go back and look at that budget? Did we follow the budget? How are we doing on the budget? Are we halfway through the month and we've spent all of our money and there's nothing left? Do we assume that we've met our budget just because we're not broke at the end of the month? So controlling actually involves reviewing the numbers and knowing where we're at. So I know businesses and individuals that make the budget but then don't follow up in the form of performance reports. And that sounds like a scary term. We get feedback in the form of performance reports that compare our actual results with the budget. And that's an essential part of the control function, is that follow-up. How did we do? Do I need to budget more food for groceries and budget more money for groceries and less money for dining out? Do I need to budget more money for gas because it's gotten more expensive? So we need to review that budget and our actual results to see how we're doing and where we need to make changes and improvements. And we'll study that in relation to businesses later in the semester. When it comes to decision making, that involves making a selection among competing alternatives. So we need to be thinking about what should we be selling, who should we be serving, and how do we execute that? Now these seem like basic questions. Hopefully we already have the big picture for our business laid out. We know what we're selling, and do we know who we're selling to? Meaning who should we be serving? Who are we selling our product to, or who are we providing services to? As we run our business and we go through planning and controlling, decision making could involve rethinking which products are most profitable for us, what customers want these products the most or want this service the most. Maybe there's a geographical region that is more inclined to one product than another. So we need to think through all of these things, and managerial accounting is going to help us make those decisions. So when it comes to various different majors, the textbook kind of runs us through planning, controlling, and decision making for different majors. I'm not going to spend a whole lot of time on it, but they bring up good points. And I do want you to read this portion in the book. A lot of you are biz admin majors. Now, I wish you were all accounting majors, but I know that's not true. A lot of you are biz admin majors, but you might need to focus in, you might need to hone in on a particular area of business so you're a little bit less generic. So they run through different kind of categories of business majors here and how managerial accounting is relevant to what your focus will be. So for marketing majors, we might be wondering, well, how much should we be budgeting for our advertising, and what different kinds of advertising, TV, print, internet? How many salespeople do we need, and where should they serve, in which territories? And then we need to follow that up with controlling and decision making. So like I said, I'm not going to run through each of these. I'm just going to quickly touch on them. Supply chain management majors. Did you know that was a thing? I think they have this major at Cal State Northridge, which I find it pretty interesting. I took a course on supply chain management and found it to be absolutely fascinating. How many units should we plan to produce next period? How much should we budget for next period's utility expense? So all kinds of planning questions that our budgets are eventually going to help with. And then when it comes to controlling, we're going to look back and see how we did. Did we spend more or less than what we had planned? Are we achieving our goal of reducing the number of defective units produced? And then decision making. How about human resource management? Have you thought about this area of business? If you're a biz admin major, I can tell you human resource specialists, people that are really good with human resources, and it can be a complicated job, are in high demand. So interesting area of business. If you're inclined to that, I would follow that inclination and try to find work in that area, because I see a lot of companies that need strong human resource departments, and they could use help. How much should we plan to spend for occupational safety training? How much should we plan to spend on employee recruitment advertising? And then we've got our controlling and our decision making. Sorry, I know I'm going super fast. What I want to get to is accounting majors, of course. When it comes to accounting majors, we're going to be doing a lot of planning, controlling, decision making, and of course managerial accounting is relevant to accounting majors. The IMA, what's that? Institute of Managerial Accountants estimates that more than 80% of professional accountants in the U.S. work in non-public accounting environments. Now, what I can tell you is that most accountants right out of college go into public accounting, and then they transition into private accounting. Now, when it comes to public versus private, hopefully you learned this in your financial accounting class, but a quick refresher, public accounting means that you work for a company that does accounting for others, for other individuals, for other companies, and whether those companies are publicly traded companies or privately held companies has nothing to do with it, but you're working in a capacity that you are open to do accounting for other people. Where private accounting is internal accounting. You work internally within a company and you're doing accounting for that company. And that could be a large company or a small company. It could be a government entity. It could be a publicly traded company or a privately held company. It doesn't matter how big or small or who owns it, but the point is that you work within that company or that organization. Where in public accounting, we work as like for an accounting firm that provides accounting to other companies. So what they're saying here, despite most people starting their careers in public accounting, 80% end up working in non-public accounting. And I can tell you from my experience working at public accounting firms, I worked at KPMG, a lot of people, while I was there, and it's still true today, a lot of people leave their jobs in public accounting and go to work for companies. And often at places like KPMG, PwC, Deloitte, you might be a staff accountant there, an accounting manager there, and you'll literally get a phone call from a client that you've worked on for a few years, and they'll call you up and say, hey, how about you quit your job there and you come work internally for us? And it happened all the time. It was surprising how, I guess, brazen they were about it. They'd call you at work and just say, hey, can you talk right now? How about you quit and come work for us? And it was really quite commonplace, which is a little bit scary in terms of the world of public accounting. There's definitely high turnover. So a lot of accountants end up working internally for companies. So to become a CMA, which is like the managerial accounting version of a CPA, right, a certified public accountant. So in the world of managerial accounting, we have a CMA. It's not nearly as prevalent as a CPA license, but if you're going to work in the world of private accounting, those are some good letters to have after your name. To become a CMA requires membership in the Institute of Management Accountants, a bachelor's degree from an accredited college, 2 continuous years of relevant professional experience, and you got to pass the CMA exam. So I've not taken the CMA exam. My understanding is that it's easier than the CPA exam. To me, if you really want to be a hotshot in accounting, you get a CPA and a CMA. I only know a few people that have that. So depending on what your goals are and where you want to work, you might want to look into that in the future. The next few slides go through some of the specifications there. I don't want to get into all of that. I'm going to kind of fast forward. If this is something you're interested in, I will let you go look it up and read a little bit about it. So when it comes to this course, the primary purpose of this course is to teach measurement skills that managers are going to use to support planning, controlling, and decision-making activities. And we're going to address all kinds of things like, how should I create a financial plan for next year? That's kind of like a budget, right? How well am I performing relative to my financial plan? So that's the follow-up portion. That's the controlling portion, comparing your budget to actual. When it comes to managing, we do need to have, we need to be able to look beyond our numbers and make smart decisions when it comes to our business in terms of ethics, strategic management, enterprise risk management. Do we know what that means? We'll get to it in a bit. Corporate social responsibility. Do you know what that one means? We'll get to that in a bit too. Process management perspective and leadership perspective. So we'll touch on all of these lightly. As we talk about ethics, obviously ethics is a big deal in accounting. Public accounting especially, but private accounting as well. We need to act ethically, and they go through some of the guidelines that are included in that. So these are from the IMA, and so it starts with competence. Again, I'm not going to read through all of this. I'll let you go back and visit it, read your textbook. So obviously part of being ethical is being competent in what you're doing. If you don't know what you're doing, then you need to get more training and education. So you can't provide accurate, clear, concise, and timely information if you're incompetent and you don't know what you're doing. Next, we have confidentiality. Working internally within a company, you might have access to all kinds of interesting information, and you need to be very careful about keeping that information confidential. There can be serious legal issues if you leak information to people outside of the company, and you even need to be careful about who you share information with within the company. So confidentiality is a big deal. Integrity. We kind of need integrity in every career, but especially in accounting. So we need to conduct ourselves with integrity at all times. So that includes mitigating conflicts of interest, advising others of those potential conflicts, refrain from conduct that would prejudice carrying out duties ethically, abstain from activities that might discredit the profession. So we need to operate as accountants with integrity, both in our professional and our personal lives. Credibility. And again, this is super important in financial accounting. If we lose our credibility, then in the world of accounting, we're pretty much nobody anymore. If we can't be trusted, if people can't believe what we say, if they can't believe the numbers that we report, then we're no good. I'll spare you the time of the entire Enron Arthur Andersen debacle, but there became an issue of credibility with the accountants at Arthur Andersen that ultimately destroyed the firm. So credibility is everything in the world of accounting, whether it's public or private accounting. So these next two slides go through resolution of an ethical conflict. Again, I'm not going to read through this. You can do that on your own time. Read the textbook. This next one, they ask a big, broad question. Once you guys get to know me, you'll know that I'm somewhat critical of textbooks, and this particular textbook definitely makes some big, broad, sweeping generalizations, and this slide is one of them. But that doesn't mean that we should completely disregard it. There's definitely some truths here, but it's not something that I would put the word always after. So the question, why have ethical standards? And they say ethical standards in business are essential for a smooth functioning economy. That's a pretty big statement. Can we have a smooth functioning economy if we don't have ethical standards? Well, maybe it's possible, but I can see why ethical standards would help create a smooth functioning economy. They say without ethical standards in business, the economy and all of us who depend on it for jobs, goods, and services would suffer. That seems a little extreme to me. All of us would suffer. What does suffer mean? Truly suffer? Or maybe we would be economically damaged? Or maybe we really would suffer. That seems like a harsh word. And then they jump to abandoning ethical standards in business would lead to a lower quality of life with less desirable goods and services at higher prices. It could. So let's walk through an example. Ethical standards in business are essential for a smooth functioning economy. So let's say that we abandon the ethical standard of labor laws. Let's say that we're allowed to use sweatshop labor and we can buy our goods from a sweatshop. You know what I mean by a sweatshop? People that work in horrible working conditions for pennies a day. So let's say that we abandon that ethical standard and we can now buy our goods. We can buy them from overseas, from companies that use sweatshop labor, and it could include child labor. It could include people that work, 18 hours a day for pennies. So we've abandoned that standard, and without ethical standards, the economy and all of us who depend on it for jobs, goods, and services would suffer. So what's the consequence? If we're a big manufacturing company and we decide to stop buying from a company in the US that pays its employees fairly, at least minimum wage plus insurance, and we abandon that and we buy our goods from a sweatshop on the other side of the world. Who's going to be damaged by that? Well, all the workers at the US factory, they're going to lose their jobs. What does it do to the cost of the product? So overall, our company is paying less, and therefore we can sell it for less. So it's going to push down the price of goods, or our company can just make more money. One of the two, maybe a little bit of both. Okay, but now all these people have lost their jobs, right? And now they don't have money to buy basic things like food and clothing and housing. So we can see by abandoning that ethical standard that there's definitely people that are damaged by it. Are they truly suffering? Well, we're not sure. It's just an example. But what does that do? It puts pressure on the wages of the U.S. worker. Why should we pay you $15 an hour, $20 an hour, when people on the other side of the world will work for $1 a day? And then we just have to ship the stuff here. So why should we have to deal with you and your demand for high wages when we could buy it for cheap somewhere else? I'm not sure that's really good for our economy, is it? So we can see how that could damage our economy. So jobs, goods, and services, and it puts a downward pressure on wages of U.S. workers. So then we jump to abandoning ethical standards in business would lead to a lower quality of life with less desirable goods and services at higher prices. So when they say lead to a lower quality of life, yeah, people are going to start losing their jobs, and that has effect on the overall economy. There's less dollars in the economy, people have less money to spend, and they have a lower quality of life. If you don't have a job, you're not going to be doing things like going on vacation and buying nice things. You're just trying to get by. And they say with less desirable goods, so maybe we're getting lower quality goods from overseas, and services at higher prices. So the price may actually go down, but relative to the hourly wage, or for somebody who's unemployed, it might be relatively a higher price. So a lot to think about there in terms of our ethical standards, but it's important that we start at the beginning, that it is important that we have those standards, because if you picture what it would look like without them, whether it's labor laws or fair trade, there's all kinds of ethical standards in business. Most of them I keep thinking back to labor laws and how we treat our workers, but it could even go to where we source our raw materials, those kinds of things, that we need to look out for the greater good of the people and the planet. So it's important that we have those. These might be a little bit dramatic, a little bit general for me, but if you pick an ethical standard and walk through this, you can see how getting rid of that ethical standard could damage the economy and people. Strategic management. So a strategy is basically a game plan. So remember that part. I think it comes up on a quiz or a test. A strategy is a game plan that enables a company to attract customers by distinguishing itself from competitors. So what are we doing that we can attract customers by distinguishing our company from other companies? So the focal point of a company's strategy should be its target customers. So you need to know these 3 customer value propositions. So these are essentially 3 different strategies, 3 different game plans. Now, the book speaks of these as if they're the only 3 that exist in the world. I don't agree with that. I don't think everything fits perfectly into one of these 3 bubbles. I think a lot of companies are kind of a blend of these, but it's important that a company identifies what its strategy is, what its customer value proposition is, even if it doesn't fit perfectly right here. So let's walk through these 3. We've got customer intimacy strategy, and that one we want to understand and respond to the individual customer needs. So we're talking about a company that's going to be very customized, something where the customer can have things made to order, and that we really want to do things exactly the way the customer wants it. So we're talking about a lot of individualization. Some examples we might find. So we're on page 12 in the book, if you're following along in the text. So they give us some examples. When it comes to customer intimacy, they suggest Ritz-Carlton, right? Hotel. Have you ever stayed at the Ritz? How about the Four Seasons? It's pretty exclusive, right? You got to be ready to open your wallet to stay there. Why would somebody stay there at the Ritz rather than at Motel 6? It's a room with a bed, right? So what is it that the Ritz is selling? Is it a room with a bed? No, it's service. It's individualized service. It's a feeling. It's a feeling that makes you think that they're there to serve your every need. They're going to take care of everything. The Ritz-Carlton doesn't charge high prices because they have nicer rooms with nicer beds, which they do, but it's the service that comes with it that's individualized to each customer need. So that's an example of customer intimacy strategy. Can you think of any others? So we want to think of something where you can truly customize, whether it's a product or a service, to each customer's individual needs. See if you can come up with a few. We'll move on to operational excellence strategy. And what that means is we deliver products and services faster and more conveniently and at lower prices. Operational excellence doesn't really go, in my mind at least, with the company that fits this description quite perfectly. That would be Walmart. Now, I'm not a big Walmart fan, as you might know. I can't stand shopping at Walmart. It makes me crazy. But that said, deliver products and services faster and more conveniently at lower prices. Isn't that what they do? It most certainly is. Now, we have all kinds of reasons that we might like or dislike Walmart, but if that's their strategy, then they're doing it well, more conveniently at lower prices. Where can you go to get an oil change, buy diapers, a garden hose, and salad all in one place? That's pretty convenient, and it's probably going to be the lowest prices you can find. So Walmart fits in there. What other companies do you think might fit in there? I would throw in Amazon. Now, Amazon is selling things for others. They have some of their own products, but they're selling on behalf of others. But overall, they deliver products and services faster, more conveniently, and usually at pretty low prices, depending on how good of an Amazon shopper you are. But I would put them in that category. See what other examples you can think of. We'll move on to product leadership strategy. And for this customer value proposition, we're just focusing on offering higher quality products. So our focus is on having the best product. What companies would you put in there? Well, the book, and probably a lot of you will say Apple. I'm not a huge Apple fan, but I do think that's where they like to put themselves. They're focusing in on offering the best products. What else would you put in there? Maybe high-end cars, BMW, Mercedes. What other companies focus simply on just offering the best product? See if you can come up with a few. We're going to move on to enterprise risk management. What does that mean? So when we talk about enterprise risk management, we're referring to a process used by the company to proactively identify and manage risk. This includes considering whether to avoid the risk, accept the risk, or maybe just reduce the risk. Once a company identifies its risks, perhaps the most common risk management tactic is to reduce risks by implementing specific controls. So when it comes to risk management, unfortunately, a lot of time when people say that they're in risk management or they're a risk management expert, oftentimes they just mean that they sell insurance. So they'll provide you with a financial filler if something goes wrong. So if this risk happens, then you have insurance, just like you have auto insurance in case you get in an accident. Now, buying insurance isn't going to prevent you from getting in an accident, but you've got auto insurance to financially compensate if that happens. So the insurance itself doesn't actually avoid or reduce the risk. It just kind of says, well, I accept the risk, but I'm going to financially mitigate that by buying insurance. And the same is true in business, whether it's auto insurance, business insurance, some form of liability insurance. So sometimes we accept the risk and we buy insurance. So somebody that sells insurance isn't really an enterprise risk manager. They're just selling insurance. But to get a bigger picture, we need to go through all of the risks of our company and decide which ones we're going to avoid, accept, or reduce. Here they give us a bunch of examples of business risks and what we might do to reduce those risks. So again, I'm not going to read all of this at you. I'll let you read through it. They do give a couple good examples. Maybe I'll touch on one or two. How about poor weather conditions shutting down operations? So we have to decide, how real is this risk? Well, in California, it's not that likely, but maybe in other parts of the country, it is highly likely. So if you're in an area that gets big winter storms or gets hurricanes, subject to flooding, here in the Antelope Valley, we don't have a whole lot of problems with that. We don't shut down because it's hot and windy. So, depending on where we're located, that might be a very real thing that we need to address. And they say, develop contingency plans for overcoming weather-related disruptions. So have a plan that people can work remotely, people can access the information that they need to do their jobs remotely, so that we don't have to shut down. What I don't see on here is a worldwide pandemic that's going to shut down everything for months on end. But I wish that was on there with a good example of how to reduce that risk, maybe in a later edition. What a lot of businesses do, they will look at each risk and determine the likelihood of that risk happening and the potential damage that that risk could cause them. And then they decide based on that, and they essentially plot this on a grid, the likelihood of it happening and the potential damage. They plot it on a grid and they see which ones rank the highest that they need to avoid, and then others they look at and say, okay, these ones in the middle we need to reduce, and these ones down here at the bottom, well, we just accept that and buy insurance. So here in California, I'm deathly afraid of tornadoes. And so there's a risk that our business could be wiped out by an F5 tornado. That's a very real risk. Is it highly likely in California? Maybe in other parts of the country, but not here, right? So that's a pretty scary risk, but the likelihood of it happening is quite low. So should I spend thousands and thousands of dollars trying to protect our company from an F5 tornado? Probably not. So the point here, and my example might be a little bit extreme, but we need to go through our risks and decide which of them are most likely to affect us and how deep that effect will be as we determine how to manage those risks. And that's essentially what a risk management specialist would help us with. Here we're looking at different types of internal controls for financial reporting. I'm hoping you remember all of this from Chapter 6 of Financial Accounting, so I'm not going to run through it all right now. It's just kind of a review. Most of these we touched on, maybe a little bit different name as we talked about it in Financial Accounting, but hopefully these look familiar to you. Just want to refresh your memory. But I'm going to get to corporate social responsibility. Corporate social responsibility, or CSR, is a concept whereby organizations consider the needs of all stakeholders, not stockholders, when making decisions. So CSR, when I was working on my master's degree, this was a hot topic. It was covered in every single course that I ever took. And when it comes to business education, it kind of works that way, where things become hot topic for a while and it's in all your books, and then they cycle on to something else. But here we're reminded corporate social responsibility hasn't gone away. It's just not talked about quite as much anymore. But the theory is, if we treat all of our stakeholders well, if we make decisions keeping our stakeholders in mind, not just some of them, but if we try to keep all of them in mind as we make decisions, that will financially benefit the company in the long run. Maybe not the short term. Maybe in the short term it's expensive to actually try to make all of these different stakeholders happy. So what's a stakeholder? They give us examples here, but essentially it's anyone affected by the business. So the customers, the employees that work there, the vendors or suppliers that the company buys from. How about this one? The community in which the company operates. The stockholders, now they're definitely a stakeholder as well, right? They have a financial stake in the company. And then finally, I disagree with the wording here, but the idea I'm good with, environmental and human rights advocates. Now, the advocates are not the stakeholder. The environment and humans are the stakeholders. I don't know why this book and every single book has to throw in advocates. We could just delete that word. It's the environment and the people affected by it. Are we polluting the environment? Are we treating people right? Or are we being abusive to the environment and people? Are we dumping toxic waste into the local river and putting poison into our water system? So the environment and other humans are definitely stakeholders of the business. Don't really care so much about the advocates. They play an important role, but they're not the stakeholder. So the idea here is when the company's making a decision, that we need to think of all of these different groups, not just stockholders, not just our bottom line on the income statement. If we make decisions keeping our customers, our employees, our vendors, the community in which we operate in mind, and our stockholders, and make good choices in terms of how we treat the environment and other humans, that might be a little bit expensive to start with, but the idea is that we're going to be financially rewarded down the line, that we're going to be a reputable company, we're going to be a company that operates the right way, we're going to be a company that people want to work for, and a company people want to buy from because we do the right thing. So that's the concept of CSR. So here they give you some examples. Again, I'm not going to read these at you. You can go ahead and read your book or read these on your own time. But they do give some good ones here that we want to have high quality products, etc. Moving on, we have a process management perspective. So when we talk about a process, a business process is a series of steps that are followed in order to carry out some task in business. Now, we're not going to go through all of these right now. This is just kind of a sneak peek, but we essentially need to know that the entire process, not all companies do the whole process, but some do. It starts with R&D, that means research and development, meaning figuring out what's wanted and how to make it. Product design, so designing a product to meet those needs. And then we have to manufacture the product, market the product, distribute the product, and then we have to have customer service for that product. So that's the entire value chain. Not all companies do all of that from start to finish. Some of them just do R&D and product design, and then somebody buys those concepts from them. Some of them will go R&D all the way through manufacturing, and then they sell it all to a wholesaler that then does the marketing, distribution, and customer service. So some companies just start here with the marketing, distribution, and customer service end. So it just depends on what the company's focus is, but that's the entire value chain. So here's an important concept that's going to affect what we do over the next couple chapters. It's called lean production. So lean production, sometimes also called just-in-time production, JIT, or lean production, those are interchangeable terms, so make sure you're familiar with that. It's a little bit different than traditional manufacturing, and I'll compare the two so you can see the difference. So in lean production, a customer places an order, and then we create a production order. We figure out what components are required, then we order the components. We didn't have any on hand, so now we order the components. Production begins as those parts arrive, and then the goods are delivered when we finish producing the product, whatever it may be, hopefully right when it's needed. So here's the key. We didn't have anything on hand. We don't have things sitting in inventory. We only start buying and producing. We only buy the components and start making the product once the customer places the order. So let's compare that to traditional manufacturing. So in a traditional manufacturing environment, we're going to produce the goods in anticipation of sales. We don't know what our sales are going to be next year, but we're just going to make a bunch of goods, and then we're going to store them in our inventory, and then we make sales from our finished goods inventory. What could be the downside of that? What if we end up with a lot of stuff left over in inventory? What if our product is not as popular as it used to be? Anytime we're storing inventory as well, that comes with risk. risk of inventory shrinkage. Do you remember what that means? Lost, stolen, or damaged inventory. So traditional manufacturing comes with some of these risks, and the downside that we may overproduce, or we could even underproduce our product, and then we'd have to go back and make more. So that's kind of the old way of thinking. A lot of companies are moving toward lean production or just in time. Because lean thinking only allows production in response to customer orders, the number of units produced tends to equal the number of units sold. Now that becomes mathematically important for us as we do managerial accounting in the next couple chapters. So the number of units produced tends to equal the number of units sold. That's a good thing to have, to not carry hardly anything in our inventory. This statement, the lean approach also results in fewer defects, less wasted effort, and quicker customer response times than traditional production methods. How do you feel about that statement? I'm a little iffy on part of it. When we talk about fewer defects, generally, mathematically, statistically, when we produce things in large quantities, it results in fewer defects. So if we're producing things one at a time or a few at a time for each customer order, I'm not sure that statistically that's going to end up with fewer defects. Less wasted effort? Absolutely. The idea of making a product and storing it on a shelf or storing it in a warehouse and it never being sold, that's a waste of time, effort, and money. So I definitely agree with that part. What about this? Quicker customer response times than traditional production methods. So an example here, Dell Computer used to be the absolute poster child of just-in-time or lean production. It was kind of a novel idea back in the early 90s, and they didn't carry any inventory. And you would, well, I don't want to say you'd go to their website because maybe they didn't have a website. Maybe this is back in the day of catalog sales and phone orders. That you would custom order your computer with exactly the components you want, and then they would produce it and ship it. But they did not even have those components on hand until you placed that order. And what made the company so special was its strong supply chain. There's a study done that I think from the time that you place your order, whether it was on the phone or in the days of the internet, once that became a possibility, from the time that you placed your order, they would order the components from their outside suppliers, and they would have their parts there within 5 to 6 hours. And then what made them kind of unique is their assembly methods. They would assemble the computers in pods. So they'd have a group of people all work together on the computer, and they each specialized on a different part of it, but they'd assemble the computer in these little pod groups and get it all done as quickly as possible and shipped out, which is a pretty amazing thing that the company was doing. It was quite different from how others were doing it at the time. So that all sounds nice, and you could get a computer somewhat quickly, but when it really comes to quicker customer response, being able to go to the store and buy something off the shelf, that's pretty quick. I ran into a situation where I came into my office one morning and it was the middle of tax season, and I could smell that lovely scent of burning plastic. Probably not good. Well, it turns out a fan in one of my computers had failed overnight, and it was pretty warm weather, and the computer was in a somewhat enclosed space, and it pretty much melted the computer down inside. So needless to say, I needed a new computer. I did not have time to wait, and I needed a computer that day. It's the midst of tax season. So am I going to go to Dell.com and order a computer that's going to be here in a week? Or am I going to get in my car and drive over to Best Buy when it opens and buy a computer off the shelf? So sadly for Dell, that day they lost my business. I used to have Dell computers, and then I needed a computer right away, so I bought an HP off the shelf at Best Buy because I didn't have a choice. So when we talk about quicker customer response times, I don't totally agree. Over the years, Dell has shifted its model a little bit, that you can buy a Dell off the shelf at certain retailers. So they've changed a little bit, but they still do focus in on just-in-time production and strong supply chain management. So in terms of terminology you might need to know, earlier I suggested that you need to know that lean production and just-in-time are interchangeable terms. Here I want to talk about push versus pull. And these words refer to traditional, which is a push model, versus pull, which is referring to lean production, where we let the customer demand pull our production. Where in a traditional model, we produce everything up front, so it's pushing. So if that makes sense, push is associated with traditional, where pull is referring to lean production or just in time. So make sure you're comfortable with that terminology. One more thing I want to cover that the textbook doesn't touch on a lot, but is super important to our course, is the theory of constraints. So the theory of constraints is basically this. Every organization must have at least one constraint, which is any factor that limits the organization from getting more of whatever it strives for, which is usually profit. So then the idea being that we need to focus in on elevating that constraint. So let's say that we're a manufacturing company and we would love to produce more product, and we have customers that want more product, but we don't have enough employees to do it. So how can we fix that constraint? How can we elevate that constraint? And that constraint could also be called a bottleneck. So how do we fix that? Well, we could hire more employees if we have space. We could run a second shift. Maybe we have a regular day shift that works from 8 to 5. Have we talked about throwing in a night shift, or maybe at least staying open a little bit later? Might involve hiring more employees, paying overtime. So we need to decide if that's a good idea. But to elevate our company, we're going to have to work through that constraint. And then the idea is that we reevaluate. So if we fix the bottleneck of we don't have enough employees, then we might find that we have a new bottleneck. We don't have enough machinery to produce a certain part. So then we might need to figure out how to elevate that constraint. What you'll find throughout the course is that I'm going to refer back to the theory of constraints in several of our chapters. It's an important concept to learn from in business, and it was developed in the book The Goal by Dr. Eliyahu Goldratt. He's a business consultant whose theory of constraints has become a model for systems management. Now, this book, The Goal, this might surprise you, but it's a novel about operations management and essentially managerial accounting, which might sound kind of strange. Can you really have a novel about those concepts? Yes, in fact, you can. I encourage you guys to read the book, and in fact, I offer extra credit for those of you that would like to read it and write a paper about the book and its connections to this course. Highly recommended. I'm hoping that you might make time to work that in this semester. I read the book in grad school, but I really enjoyed it and was quite surprised how well the theory of constraints was developed through this novel, and how they gave us practical applications in the context of a story. So I hope you'll choose to read that for extra credit. I will touch on it and refer to it in several chapters moving forward. So if you hear me refer to The Goal, that's what I'm talking about. Finally, a leadership perspective. Organizational leaders, managers, are supposed to unite the behavior of employees around two common themes: pursuing strategic goals and making optimal decisions. So they need to consider the different influences on behavior. We've got intrinsic motivation, extrinsic incentives, and cognitive bias. Now, I don't want to get into all of that now. We'll touch on some of those concepts later in this course, but in terms of being an effective leader, and that can include managers and even managerial accountants, we need to consider these different factors that might influence behavior. So, congratulations, you survived the prologue of the textbook. Next, we're going to dive into chapter 1. Keep reading and studying, and let me know if you guys have any questions.